So I think the difference between today and, let's say, Monday when we were on with you in the evening is that you actually saw disorderly price action and fear in the market. Okay, that was, very palpable. The way the market traded intraday, certainly the last 20 minutes or so. To us, when you think about it, and we said this and we continue to say this, is that as an investor, you have been rewarded by being a buyer down 10 to 15% consistently throughout the cycle. We do not yet see the conditions that would cause that to be any different. And when you have this kind of fear, we're not saying that today's the bottom. And obviously, if you look at it, futures closed at a discount. So we're likely going to see more selling pressure tomorrow, at least at the opening. This is the time to start carefully adding to positions.
To what? Buying what? But by the way, Julian, if you're saying that we ended on our lows, which we did, futures ended on a gap, which they did, which none of those things portends well for tomorrow. Fridays this year, as Michael Santoli has noted, have tended to be the worst day of the week so far. People don't want to be long going into the weekend. Why start now? Why not wait a little bit, see how this shakes out?
Because when the volatility is this high, 39 in the VIX, timing the market is an incredibly difficult thing to do. It's normally very, very difficult. For us, it basically it's the difference. You think about it, right? The 200-day moving average was at 30.42, and that was a support level that basically looked like it was going to hold until the last hour of the day. And now we're thinking, I think a lot of people are thinking that you can go substantially below 3,000. The point being that you need to step away and have a plan for a disciplined approach, and put a little bit in. The market moves lower, you buy a little bit more, and, really just to the point where you need to take emotion out of the equation by being disciplined.
Hey, Julian, it's Tim. So, I tend to agree with that, and I think we're going to give a few stocks throughout the course of the evening that we would do that with. But I'm curious, as you say, start to nibble back in. Do you take a sector approach? Do you take a holistic market approach? In other words, an indexed approach to a portfolio? Or do you actually find sectors that have been most beaten either due to the direct impact of the coronavirus in terms of their regional influence or their trade influence or their transport influence? How do you leg back in? And again, can you pick a sector here, or would you rather just start to put the allocation across the entire portfolio?
Sure. I think for a lot of people, there's a little bit of shock in terms of the moves of the last week or so. You want to try and quickly figure out where your own portfolio is overweight and underweight. Basically, from talking to clients, we think a lot of people are overweight tech. We think that is probably an area that isn't likely to bounce, given that it had been the leader prior. But what we would say is, the first decision is to add to exposure. So if it's a pure index, that's fine. We happen to believe that healthcare, which has been very, very attractive on a relative basis, is something to take a look at. We like it. We think it'll outperform on the way back up. And financials, I think part of the maybe unexpected part of the last few days is that the yield curve has actually been steepening. That, to us, bodes well in a sector that really has been beaten down very extensively, and we see value there from a valuation perspective as well.
Julian, just to piggyback these questions, when you look at the chemical names, which I talked about earlier, and energy names, are you getting pushback from your clients? Is it environmental and social concerns? What is troubling these names? Because if you look at a Dow that's down 24% year to date, or a handful of other names, and obviously everyone knows energy has not performed well for 5 years. What is going on with these chemical names? Is there something bigger? Because when I look at the yields, you have these stocks that are yielding 7% in some cases. It's not just about value and growth. There's a bigger thing going on here, and have you spoken to your clientele about that?
Sure, we definitely have. Obviously, the push to ESG has certainly been a headwind for those stocks and those sectors, but it's also part of the whole passive investment move. If you think about it, right, as a portfolio manager benchmarking against the S&P 500, you are not overly punished by being underweight areas like materials and energy, whose weighting in the index has dropped precipitously over the last several years as technology has increased. So basically, the trade there has been sort of, let's just continue to be underweight because it's not really going to hurt. From our point of view, and I think, if the last, sort of year to date has proven anything, is that you can have straight line moves. You certainly had one to the upside, and you're having one to the downside now, but those don't continue forever. And from our point of view, those material stocks, those energy stocks are pricing in a recession that we don't see as a base case in 2020.
Hey, Julian, it's Dan. Question on China. A lot of China bears have kind of just mentioned the fact, I guess, time and time again since the U.S. financial crisis and then how it rolled into Europe, that obviously China has a massive debt issue. Does this issue with the quarantines and just basically the lockdown of a lot of business over there, does it raise the question that finally this bubble in China, this credit bubble, could burst? And if it did burst in some way that the government really couldn't contain, does it have the likelihood to kind of roll back to Europe, roll back to the U.S.? And is that something that maybe that's what U.S. Treasuries are kind of so suppressed? Maybe that's the thing.
It's a very, very fair question. I think the China story becoming unraveled has probably been around for 5 or 6 years. We always wonder whether this is the moment. It's hard to say it isn't based on what we know, but what we would say is you look at it, there's $3 trillion in terms of FX reserves. There are a lot of things that China can do to stimulate the economy. They may not necessarily work now because of the quarantine situation, but once that eases up, and that does seem to be the case, the reported cases have leveled off, is that there is enough potential for stimulus that we don't think this is, the bursting of the situation yet.